lenders right now, what we're seeing is that they're doing everything possible to prevent some transaction event that their internal credit committee or the regulators look at and say, okay, you got to write this down. If they foreclose, they have to. If you went for a receiver, you have to. They're trying to do things, play the game of Twister to make the loan still look good as long as they can.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this YouTube podcast series, Real Estate Market Watch, current events through a real estate lens. My guest today is Norman Radow of RADCO Companies. Oh my goodness. It turns out that Norman, Dr. Norman, is Mr. Distressed Real Estate. Oh my goodness me, you're going to hear right at the very top how he started his career in commercial real estate. And it definitely lends a perspective that Norman has on the commercial real estate world today and how it's evolving at the moment that is very different from what I call the normal pathway to getting into real estate. Is you work for a company or you start a company and typically you build that company during the good times. Well, Norman's seen it from a very different perspective. So the lens with which he discusses commercial real estate is different from anything you are likely to have ever heard before. Okay, before we get going, please if you remember, go to GowerCrowd.com, hit the subscribe button, sign up for my newsletter. I do send out summaries of these podcasts. And also, if you're not connected on LinkedIn, 2 calls to action. Connect with me on LinkedIn. I'm having a lot of fun with meeting people over there, including Norm, actually, on LinkedIn. It's a great place to meet and greet and to get to know some very, very interesting and bright people. Okay, so that's there on LinkedIn. All right, let's get started. Norman Radow, RADCO Companies, boom, coming right up. Norman, what a pleasure to meet you. Thank you so much for joining me on the podcast. Having come from a world of distressed real estate, I'm particularly interested in your solutions platform. So I'm going to quote something that you mentioned on LinkedIn, or paraphrase it slightly. You said 4 months, this was 4 months ago. You posted on LinkedIn, and you said that you've been waiting patiently for 3 years to rescue struggling assets. So, of course, I have to ask, why the wait? What triggered the start, and what trends are you seeing today, 4 months later?
Wow, that's a great question. And I think I have to take you back 30 years to get to this platform. You know, there's an old joke about the Governor Connolly of Texas. And back when he was alive, Governor Connolly was with JFK when he was shot. In 1962, to give you context, and there were these 2 guys that had invented some piece of equipment that would revolutionize the oil industry, and they couldn't get into Exxon or Mobil, so they went to Governor Connolly, who was then a consultant, and they told him all about it, and he said, "Oh my gosh, hold on." He gets up, moves to his desk, calls the chairman of the board of Exxon, gets right through, tells him there are 2 guys that you got to meet, sets up a meeting for next Tuesday. And the 2 guys go, "Oh my God, we tried for 2 years. We couldn't do it. It's incredible. Thank you so much." I said, "What do we owe you, for your time?" And he said, "You owe me $1 million. This is like in 1970s dollars. They go, $1 million? You just spent 5 minutes on the phone. That's all you spent. Why would we pay you $1 million? He said, "Son, that 5-minute call took me 30 years to make." And so I want to go back 30 years. And our first deal was buying the Four Seasons Hotel office and condo tower in Atlanta, 53-story building. It's still one of the great buildings in Atlanta, out of bankruptcy in Sweden. It was incredibly complex. And I was a young man. I didn't have a pot to piss in. Can I say that on a podcast? And it's and maybe because of my naivete and optimism, I was able to close that deal. 100-hour closing. It was a 100-hour straight closing. And I bought
Mm.
that deal. And I did one after another as a boutique company. And by the way, one of the great things about that deal was Lehman Brothers provided me the capital.
Mm.
And when I got my first interest statement, it said LBHI, Lehman Brothers Holding Inc., loan number 0001.
Oh my
And
goodness.
and so
Wow.
Lehman then backed me. I did one deal after another. And then in
Mm.
1999, they started asking me to look at underperforming real estate they had. And I'd go in, write up business plans or, critiques. And then they would ask me uh,
Mm.
undertake a UCC foreclosure, take over those assets. And so before you know it, I became their off-balance sheet workout company. They didn't want to have the
Mm.
perception they were a loan-to-own shop, so they never wanted to foreclose on their own. So we would create a separate LLC, RADCO, Smith Property, and they would assign or it would buy the project at the UCC foreclosure, but Lehman would be the owner, but you'd never see that. And so I was working out property after property, high rises under construction, tons of
Mm.
litigation. I mean, messiest things you can imagine. And then in 2008, 3 days after Lehman went under, 3 days, and you remember this time, how incredible it was, how scary it was. I was called
Mm.
up to Lehman headquarters. I was put into a back room, windowless room. I always got the VIP treatment. Now I'm put in a back room, no windows. And they said, wait right here. And then 4 analysts came in, two per cart with 2 carts, and files were up to like 6 feet high, and they're falling off, and they're grabbing him and putting him back on, and they're bringing him in. And I asked, well, what's that? And they said, anyone who knows what that is has been let go. You're now in charge. And so I was left to unwind
Wow.
almost all of Lehman's real estate in bankruptcy. Some of that just trying to value where their position were they in the money to fight for it, negotiating through intercreditor agreements, what could I get control of the asset? If I got control of the asset, how would I maximize its value? Should I sell it? Should I operate it? Should I enhance its value? Drive it through this incredibly weak market to the other side? Whatever it was, we did that. So that just gives you an idea about the expertise and the years I spent unraveling some of the most sophisticated and intricate workouts we've seen probably in this century. And so
No, let me ask you. Oh, sorry, go ahead.
the New York Times did an front page article, 3,000 words on us in 2009, calling me and Radco the workout king in the United States in 2009. So that would just give you a sense of our experience in this space.
Right. So your exposure to real estate is very unusual, actually. Your exposure is, or the genesis of your life in real estate is through distressed real estate. Is that correct? Based on what you've said 30 years ago. So savings and loan crisis, basically.
Right. It's like I didn't realize that's what it was. It's like I gravitated to it. I'm a lawyer by training, and I did a lot of workouts as a private attorney.
Okay.
And so I just seemed to gravitate to it. And then one day, my assistant said to me, "You know what you really are? You're a workout specialist." And I go, "Huh? Really? That's what I just thought everybody did that." And,
So let me ask you this then. So, that's unusual. Most people come into real estate, they buy a house or they work for a developer or they do some value add stuff, and they work during the bull cycle, right? The bull phase of the cycle.
right.
You come in RTC days, during the savings and loan crisis of the 90s. You talked about the global financial crisis. So does this background, or in what way does this background give you a different view of commercial real estate than somebody that has come in, I'm going to say the usual way, which is through not distress, but through opportunities?
Yes, so that's a great question,
Mm.
and I think it's been asked the right way. So I'll tell you something we did in 2009. We're handling so many problems all throughout the country. You cannot imagine it. For example, I was president of 5 um, golf communities. I don't play golf, but there was a golf equestrian. I did golf skiing. I had a golf,
Mm.
uh, you know, uh, uh, on the water in Estero. So and so I had all these golf communities, and I want to talk about some of the things I found there. But we had so many properties, condo properties, apartment properties, and nursing homes, just anything you can imagine, and land in California. I think we had 50,000 acres of land that I was chief restructuring officer for. And we had dual bankruptcies between the developer and Lehman Brothers, duking it out, which court had jurisdiction, and it was a incredible battle. So we had all this kind of stuff. So I said on my analysts, I said, why don't we try to make this a little easier so that, as we parcel out work, we know what to look for. So I said, let's find the common denominators of all these failed developments and see if there's some things that give you a sort of a list of things to look for in these kind of assets. So just to show you my age and my technological prowess, I put up easels with oak tag, along the conference room, like there are like 8 of them. And we said, okay, let's take this property. Property X, what was wrong with this property? Oh, it was undercapitalized. Okay, undercapitalized. And then we came up with 6, 8 things that were wrong. And then we went to the next property. Oh, it was undercapitalized. Oh, we got 2 of those. And it was the business plan was wrong for the market. Okay, and so we went through all of these properties. And I think we did 24 properties, and in fact, we took all condos because we wanted to do it by asset class. And so you had 5 of this. The probity of the developer, was a little questionable and a little shaky. And this, you have 5 of this, 3 of that, 6 of this. But one had all 24 properties, and that was issue was faced with changed market circumstances. The developer didn't change his business plan. All 24. Whether you're undercapitalized, this is wrong, that's wrong. When faced with the issue, what do you do? And almost all of them doubled down. And I'm going to give you a Walt Disney true life adventure story that was the exclamation on the period of this little test. I was foreclosing on a $500 million condo conversion in LA. And there was a personal guarantee on the loan, but in California, it would take 2 or 3 or 4 years in litigation to foreclose. So I offered to waive the personal guarantee to get to the asset, and I offered some parting gifts to the sponsor. And in exchange, also for a little ego stroking, because he also had several other loans I was going to be tackling later, I asked him to be a consultant to, advise me and, about some things. So I took him to lunch, and, he's not happy to be there. And, I flattered him as much as I could. And I said that, I've never done business in California before. I don't know the politics. I don't know all the regulations. I don't know the brokers, and so I was hoping you could give me some advice. And he says, well, what advice can you give me? Do you want? And I said, faced with, the current situation, what advice would you give me now about what you would change? Given the world has changed and and it's a failed project, what would you do differently? And he got red-faced. And he started pounding the table. I had to reach for my glass of water. It was about to fall off the table, literally. He was so angry. He was pounding the table. And he said, I wouldn't change a thing. I did everything right. And of course, my response was, then why am I here?
Obviously not.
So,
Yeah.
and the truth is, if he had changed, said, hey, I'm going to do this, I'm going to cut the pricing, I'm going to, market differently, I'm going to go back to apartments and rent them to get cash flow temporarily until the market changes. He could have done any one of those things or 100 of those things and written up a business plan. The last thing I needed to do was take over a 1,294 unit condo conversion in Woodland Hills, California. So,
Okay.
like, if you had done it, I would have backed you. But he didn't change. He did everything right.
Okay, so I have a very important question for you. So it's interesting you say this. Just by way of background, so you know a little bit more about who you're talking to. I actually worked for East West Bank during the global financial crisis. Went through the RTC and worked with Japanese investors on their workouts. And then during the global financial crisis at East West Bank and worked, so not the same scale as you, but $1 billion of notes then, $7 billion portfolio at Colony Capital, who'd done a lot of deals with the FDIC, actually in partnership with the FDIC. You would know that. Not many people don't. Not many people do. But I've been pondering what are the common threads that that sponsors adopt throughout downturns. And I looked all the way back. I'm a historian as well, but I looked all the way back at the Great Depression, the Great Depression 29, and looked at all downturns. And there are some common threads that feed through that is consistent, and one of them is exactly what you just described: the ability to pivot and change when the environment shifts around you. You've got to be creative. So my question to you is, this gentleman that you were sitting in front of, you were asking him for advice, but presumably you would have given him some advice as well. What advice would you have given to him if you'd been able to spin the clock back pre-downturn, that he would have done differently, that would have saved him from having that lunch with you?
So, this may not help your viewers only because it's very specific to this property. Okay. But it was 1,294 unit B-class apartment complex with 5 entrances. And it was right off the 101. You got off the 101, you went right into the property, the gate of the property, and you turn left or right, or it would go straight through it. And what I would have done is done it phase by phase. Because if he failed at any, it was 100% occupied or 95% occupied. So if you did it phase by phase, then you would have kept all the income, right? You would have had all that cash flow, and then if one phase failed, you could backtrack and you had a smaller problem. And and he didn't do that. He had a hubris that, the market was so strong, which it was. Remember 2004 was the condo craze, 2005 was the condo craze, and but that craze ended, pretty quick. And
okay, so what he was, just to clarify, so what he was doing was renovating and condominiumizing the entire project all at once.
Right, he did one pallet, one renovation pallet. So didn't account for like tastes of the market. If you do 1,294 units, not everyone likes the same thing, and even during the course of a sellout over 2 or 3 years, market tastes change. If you start raising your prices because you're doing well, someone paying $50,000 more may have a higher level of finish requirement. And he didn't, he just made it simple. One thing, boom, and then he emptied the properties all at once, condoed it all at once, all 5 phases, and I couldn't put Humpty Dumpty back together. So I had, 50 units sold in one phase, 150 in another, 80 and up, so I had like 300-400 units sold. So I still had 900 empty units, but they were all over the place. So I couldn't deconstruct the condominium and convert it back to apartment. So I would have said, if you were successful, if you were right, and the market was so hot and you could have sold it all at once, you would have made a little more money, but you risked everything for that, rather than do it phase by phase. So 300 units, if you sold 150 and you're doing really well and you're selling 20 a month, you can start phase two, and get that ready just when you're finishing phase one. But he didn't do that. So that's what my lesson learned for me, looking at that. I would have advised him if he had come to me years before.
Yeah. Yeah, and also you kind of the mind boggles. It's always easy in hindsight, but to wonder how he was actually financed as well to do such a huge project.
So the answer was in 2005. One of the things I noticed at Lehman, and Lehman wasn't the only one, because very often Credit Suisse would be in, pick a bank, Barclays would have been, like they split the loan, or somehow they were side by side in the capital stack. $500 million became the new normal in 2005. Like, it's just cheaper to put out 500 million than to put out $250 million, loans or equity tranches. And so they were looking for those the Lehmans of the world were looking for those large transactions so they could book the fees, then. And, so that's all of a sudden, you may have seen there's a lawsuit against Credit Suisse by I forgot the name of the case. I'll remember it in a moment. A case of a ski resort, a little town. They're building residentials around the ski resort and golf. So they're building all of that. And this woman, it was a woman, she went bankrupt and she couldn't pay the mortgage in 2009. Credit Suisse moved to foreclose. She sued to stay the foreclosure and called it negligent lending.
Negligent lending. I was conned.
And because what the case showed is she was asking for 200 million, and they came back and said, no, we'll lend you 500 million, make the project bigger. And she actually won that case. She actually won that case and got a stay of the foreclosure and a judge.
Okay.
Credit Suisse. So everybody wanted to do a $500 million deal then. That was like the flavor of the year.
Norman, let me just tell you something. I would love to sit down with you and actually spend really long time talking about this stuff. It's been the bread and butter through my career as well. Similarly, not by design, originally during the savings and loan crisis. Yes,
I did a lot of that too, but I was a lawyer then. My teeth on that.
I've raised a lot of money for ground up multifamily in Southern California from Japanese investors that all went poof. That's how I ended up in Japan, actually, in the 90s, was helping them. But actually, let me ask something there.
Yes.
All right. So I sincerely would like to learn more from you and to talk more about this, but we've got limited time. So
going to the original question, which
let's spin forwards. Right. Let's spin forwards. Why now?
Right. To me, the solution for underperforming real estate was all that experience. And so we looked at so 2022, March of 22. I'm going to tell you, this is a true story. I'm on a catamaran, a giant, like a 70-foot catamaran, and we invited several real estate, people for vacation. It was one of them was a broker, a multifamily broker, a very big multifamily broker, and he brought a sat phone with him just in case. But things are going great. 21, first couple months of 22, the best sales months, best fees they've ever made in history. And comes to this wife, having a great time. And like 2 days into we're in the BVI's, all of a sudden his phone lights up. Every deal he's working on crashes. Every deal. And he's pacing the deck. He's on the phone back and forth like 10 hours a day, 8 in the morning till like 7 or 8 at night. So it's more than that even. He's just pacing back and forth. And what I'd overhear and what he told me afterwards is every buyer was walking away. They weren't, he was trying to keep these deals together. It wasn't a question of retrading. The buyer said, we don't know what to retrade to. Because two things were happening at once. that 15% rent growth we saw during the moratorium, the eviction moratorium during COVID in 20 and 21 stopped. I mean, I saw it too in a few properties we had left. It stopped. And at the same time, the Fed started raising interest rates. There was a double whammy, and equity just shut down. End of March of 22. And I saw it that day it happened because I was there and witnessed, my friend just going back and forth on the boat all day trying to, and he was so frustrated because he could not find a solution. Is it $1 million discount? 2 million? 5? What do you need to get this deal done? And he said, they said, we don't know. Debt pulled back, so you didn't know if you can get debt and what the spreads were widening overnight. It was a crazy time. So that day, I said, aha, the markets, the cycle is beginning. Take a shorter step back. I had 26,000 apartment units in 2019. The day of that phone call, I had 1,000. I sold into the hubris of 20 and 21. And so now I'm sitting there in March of 22 saying the cycle's going to start again. And for 3 years, here we are, 3.5 years, I'm waiting for that cycle.
All right, so there's a lot happening at the moment. In fact, I'm not sure if you read this morning. I put it out actually in my newsletter as well today. But there's a lot going on policy-wise. First of all, we've got some very substantial deregulation. Okay, so the big problem with the hubris is liquidity. Too much cash in the market. So we're going back to Lehman Brothers.
Yes.
You want 200 million. Can we lend you 500 million? It's actually very similar to how the Japanese bubble ended up bursting from the 80s going into the 90s. Yeah, right. It's very similar. But today, so now we've got deregulation going back to pre-2008 banking standards. Likely, it was just reported, I think, Alval and I forget the name. Yes, just reported 2.6 trillion of liquidity likely to be pumped back into the economy. Plus the inevitability, and you correct me if you think I'm wrong, of interest rates coming down.
Well, Jerome Powell just today he's going to cut again at the end of this month.
Yes, if not, but significantly, if not before he terms out, certainly after he terms out, for whatever reasons, right? You don't need to get into that.
Right reasons or political reasons, right?
Massive liquidity being re-injected into the market today to pre-2008 kind of levels, maybe even greater. Is this not going to, and I'm pretty sure I know what your answer is, so I'm going to frame it in a way that allows to tease you up, to tease it up. But are we not actually, is the economy now not likely to go into a period of considerable boom with all this new liquidity, and all the distress is going to go away, interest rates are going to come down, the extend and pretend is going to be solved because interest rates come down, liquidity, regulation, deregs, etc. Aren't we in line for some boom times, Norman?
Well, fantasy is a wonderful thing. They really is. There are many channels on cable that you can watch, and you think you're a stud. But I don't think it's as simple as that. There are a lot of things that are different now than they were in the last cycle. But let's start with what's today. Let's not talk about tomorrow right now.
Sure.
So if you look at we sold deals in 21, the end of 21, for 3.5 caps. 80s product, right? Some 70s product. 3.5 caps. In some cases, 3.5 caps on pro forma revenue because rents were going up 15%. And so the buyers, guys from Lakewood, New Jersey, running down here with their spreadsheets, they're smarter than everybody else. I know that because they told me, and they bought these at 3.5 caps or lower, and then borrowed at, let's say, 250 over. Then it was LIBOR, but what's called SOFR today, and SOFR was 15 bips. So they're borrowing at 265. But it seems to make sense. 3.5 they buy a cap for a year, it costs them 20 grand, and they just think they're the smartest thing in the world. And then that March 22 happens, and boom, rent just starts going down, not up. And I can tell you, I assure you, because we're also in third-party management, that in Atlanta, as an example, where I know the market best, but I was certainly in 13 states at the time, we had about 5% rent decreases for 3 straight years in a row. In fact, only in the last 4 months, our lease trade outs have higher rents than the leases they are replacing. First time in over 3 years. So now you have rents coming down. Insurance rates quadruple and fiftuple. I mean, they go crazy, particularly in coastal markets, Florida, but even here in Atlanta, went up from the low. They went up 9 times, 8 times in a several year period. I mean, that's extraordinary. Cap that, take that expense and then cap it and take it from your value. So that hurts. But all of a sudden, interest rates, the big thing, interest rates go from that 15 bips or so to 5 and a quarter, right? And you're paying 250 over, so you're at 7 3/4, but you bought a 3.5 cap. And your rents may have gone up for a few months, but now they've gone down year after year after year. But that dog don't hunt. And you start doing the math today, and almost all those properties bought in 21 and some in 20, depending on how much runway they had before the change happened. Those deals are not only underwater to the equity, but probably 20 or 30% of the debt. So you're probably even the B piece of the debt, the participating part of the debt, the risk part of the debt, the valuation is just, destructed right through that down into the heart of the loan. And I'm seeing that in probably half of the deals we're managing now, which are legacy deals. The other half are deals that we're managing now for the lenders, the pref lenders, the LP that kicked out their sponsors, that they've been recapitalized. But the other half, they're all underwater by about the amount I've just said. And these sponsors are struggling and trying to, figure out how to deal with this. Some of them actually are trying to give the keys back, and the lenders won't take them because nobody wants a transaction. Talk about extend and pretend. I have a better a phrase I invented in 09, which you may have heard because I've said it so many times, but a rolling loan gathers no loss.
That's really good.
Yeah, it's a little more elegant. It's got a little poetry to it.
That's very clever.
And pretend. So lenders right now, what we're seeing is that they're doing everything possible to prevent some transaction event that their internal credit committee or the regulators look at and say, okay, you got to write this down.
But they're not being forced to market like they were during the GFC. No,
that's the point.
It's fundamentally different.
If they foreclose, they have to, right? If you start, if you went for a receiver, you have to. So, they're trying to do things, play the game of Twister to make the loan still look good as long as they can. And so, as an example, we bid on a deal, 80s deal, had 10-12% delinquency, 80% occupancy, when had about $1 million of deferred maintenance. It was in decline. It was in its death spiral, and the sponsor put it on the market, hoping to collect something of their equity. And we bid. Let me just say, we bid 25% below the loan amount, and we were in the best and final. So we were one of the two top bids. I think we're basically the same. And it's actually a friend of mine. I later found out who's the other bidder, a very well-known company. And so all of a sudden the sponsor is out of the discussion, and now we're talking to the lender. So the lender comes back and says, we don't want to take a 25% haircut, Norm. So how about we stay in? How about we modify the loan? How about they're just throwing out ideas, A, B structures, come up with something innovative that we don't have to write off all that money. So I came up with two proposals, an A, B structure and a loan modification and turning it into a cash flow loan to give us time to stabilize the asset. And so I gave them both offers. And then we had a call about that and then silence. And then 3 weeks later, they gave the sponsor
the same deal,
the free extension. Now, you say, oh, no, what's wrong with that? What's wrong with that is that the sponsor, first of all, the sponsor is the one with unclean hands. And in the last cycle, lenders didn't want to make deals with the sponsors who had unclean hands because they said, why am I going to reward the guy that, the sponsor that, crashed and burned? I'd rather bring in another fresh sponsor who has clean hands. But they're willing to do that. Okay, that's a policy issue. But from a financial point of view, in this case, the sponsor was a fund that was out of money, that they were so far underwater on this deal that they would never claw back to get to their equity. So they had no economic incentive. And they didn't own the vertical, the operating vertical. They had no management company, no asset management company, no construction company. They were third partying everything. So they're not even getting fees. So now you're tasking a company that, in fact, it was so bad that they had to claw back from all their investors, from all their principals, not their investors, the promote they had taken on the early deals because these deals were unraveling. The promote, and they had a clawback provision, so they had to actually write.
Why on earth? So what kind of depth? This is, I mean, again, it's really kind of cool to go into the weeds.
But there's no one said, like, what are they going to do?
But right? Why would a bank do that though?
Because if they changed owners,
that's they have to purchase a write-off.
Then somebody's going to see that.
I see.
It's going to cause a revaluation of their mark.
So a weak bank, presumably. I mean, I still talk to East West. Still close.
A bank you would know, roll off the tongue, very big bank. So yeah. But you realize if it's on that loan, what about the other $2 billion?
Exactly. What else is going on? So
what are the others? Then they'll have to go revisit and
so Norm, are they holding their breath waiting for interest rates to come down to save the day?
That and there's also a hope, and you know how I love hope on a business plan, that there's a hope that the excess supply, which I didn't mention before, that coming out of the hubris of 20 and 21, when interest rates were at 15 bips, right? Everyone in their and you had 15% rent growth. So you go, wow, look at that rent growth. How much that is. Everyone started building. So nationally, produced 5 times, 4 or 5 times, I think it was 4 times, I'm sorry, 4 times the national average of home deliveries for the past decade in 23 and 24 and early 25. 4 times. So you're taking 40 times as much supply in the market all at once, not one time, but a second time, and then a third time. And so even though you had good absorption, if you're absorbing 250,000 units a year and you're building 1 million, you cause a lot of vacancy, which caused a lot of, all the algorithms, rent algorithms started, slashing and burning the rents. Also, then you had fraud that was, rising. So, it's now organized fraud. You can go on TikTok and write in, how do I defraud my landlord? And you'll get like 10 websites come up with, it's not websites, whatever they're called in TikTok, that then say, what is the operating software of your landlord? And you tell them, oh, they're using Yardi, so-and-so. And they then sell you a kit on how to get around the software.
The application process.
The application process. So that becomes big. So all these things are happening at once, and you have all this excess supply. And so now there's some hope that excess supply is ending. It's about ended now. And you still have strong demand. With house prices so high, fewer and fewer people are buying, so there's still strong demand. So the thought is there'll be absorption this year and early next year, and come the second half of 26 and 27, you're going to see some significant rent growth. And because it takes so long to start a project, and get financing, permitting, deliver it, that you have 3, 4, 5 year runway of rent growth. And so that's some of the thought I think that's going into this. But in between, you have families living in these properties that are in purgatory. But the sponsor's not putting up money, the sponsor doesn't care, the lender is not putting up money. Why should I put money? We don't own it. And so, you're seeing a lot of now
deferred maintenance just being left.
That's right.
Yeah, I saw that that's the thing with distress, is that it's distress for a reason. And then if a borrower hasn't been paying, they've also not been upkeeping a property either. So there's all kinds of problems once you get in there, as you well know. But
we're seeing it now.
So, so your response to my question about excess liquidity coming into the market, deregulation.
I never got to the excessive liquidity.
Right, and was to describe it, as being some kind of fantasy. But the likelihood is that is what's going to happen, unless you disagree with me. We are going to see liquidity.
But let's talk about So spreads right now are coming down. Lenders are starting to offer higher leverage. Now, it's not the 85-90% leverage, they're going from 60 to 65 or 62 to 67. It's not crazy. Spreads are coming down from 350, maybe on on those bridge products, to 280. Still over four SOFR. It's still 6+%. Properties aren't selling for 7 caps now, so. You need a 7 cap to pay 6 and something. Now if it's a stabilized Class A asset, you can get Fannie and Freddie debt at about 5, 5.25. Let's talk about those for a second.
Sure.
That liquidity that you're talking about is out there, and it is acting like liquidity does in the stock market at the beginning of a cycle. At the beginning of a cycle, where does liquidity go in the stock market? It goes to large caps. And then once the large caps are valued up, then you go, oh, now they created value for the mid caps, right? And then it goes there, and then it does it to the small caps last. And that's what's happening in multifamily. So this equity is targeting new, core, stable assets. And because you could get 35 or 40 bids on one of those, and that's driving the cap rates down in some cases to the low 4s. I just said that the interest rates are 5.25, even for a Blackstone or or any of those big equity shops or the REITs. It's still 5. Fannie will give you 5 bips better, or 10 bips, but it's going to be 5, 5.25. So if you're buying at a 4.25 and borrowing at a 5.25, you have a very significant negative ARB. And the argument the buyers are making, the equity's making, is that, hey, supply is dwindling, demand is high, we're filling up, and there'll be rent growth in the next 3 or 4 years. But that's a bet. Now, I think it's a good bet, but it's a bet nonetheless, right?
Are they betting on lower interest rates and refinancing into lower interest rates as well?
No, not 3, 4 months ago. Today, I would say that, but in July, Powell was saying, no way, right? So, so you couldn't really bet on it in July until, 30 days ago when he started cutting and signaling he would cut more. So now you could argue that, but that's not affecting Fannie and Freddie because fixed rate debt's based on treasuries, which have been pretty constant at between 4 and 450, right, on a 10-year. So if you go to a 5-year, the quotes I'm giving you a 5-year is 3.7 right now. So on a 5-year, so even a 140, 150 basis point spread, which is a pretty good spread, you're at 5.25. So you're borrowing at 5.25 because a lot of these big shops want fixed rate debt, and you're buying at a 4.25. That is a lot of rent growth that you need to claw back to get to a neutral ARB.
So what's the logic behind that, Norm? I mean, what's driving that trade?
Well, they're modeling very strong rent growth for a significant period of time, and they're arguing, and I think there's a good argument here, that we're buying below replacement cost.
Yes.
And even at a 4.25 cap, you're buying it at 50,000 a unit less than today's replacement cost. And ergo, no one's going to build more until the rents come up to justify that higher basis. And if they do, great, we'll sell into that and we'll make 50,000 a unit. And so that's their argument. But as an entrepreneur, I want to have a neutral or a positive ARB to start. And that way, those things that they're assuming, they're my gravy. They're not my hope and prayer. So that's the difference. So, but the money coming in now is focusing on those assets. So as you start taking away one of the check boxes, like core, it's not in core, then like 10 of those 40 groups are not bidding on it. Oh, it's in lease up, or it's struggling because now competing in year 2 against its own renewals, 5 more guys won't be involved. It has delinquency. It's not brand new. It's it's 2000 product. And so you go down the list of things. And so when you start, outside that Class A core, it gets smaller and smaller and smaller, the amount of equity that's out there. So if I'm bidding, Norm Radow, RADCO's bidding, which we are, and we are buying, but very gingerly, given what I just said, that the more hair on a deal, the more likely we'll be able to buy it, because there'll be fewer and fewer competitors, and probably none of those competitors will be institutions. And so that's what we're actually seeing happening on the ground, that the further you get away from that core, the less equity there really is out there. And that's where you're seeing an enormous amount of transactions not taking place. That they're on the market and they never seem to close.
All right. So the business that I'm in is helping sponsors raise equity capital from individual investors, right, through syndication, Reg D 506C, accredited investors. That's all I do is build systems for sponsors to raise money from individuals. So for those people who are not in the institutional world necessarily, what is the play today? I mean, we've talked about distress. Is it only distress? I mean, it's okay if it is. I have a, I do. So I spoke to Erica Groshen, who was a former commissioner of BLS a couple of weeks ago. It's my earlier podcast. And she described the inevitability as being of liquidity coming into the market and interest rates coming down for whatever reason, particularly if it's through political pressure, that the market will boom in what she described, her term was a sugar rush. And when the sugar rush is burned off, we'll have a hangover, and we'll see. It's almost as though we're sitting in 2005 and we know what's going to come, right? We know what's going to come. So I'll
change your analogy a little.
Sure.
You already had the sugar rush in 20 and 21. You had all that liquidity with all those, federal bailout money coming in. Billions and billions.
But you don't think you don't think we're sitting at the cusp of another one? And my question is,
I think this is, so we haven't finished this last go round from that.
The last one.
Right. You're taking a Bloody Mary. You already have a hangover. You're taking a Bloody Mary
to cure it.
Over. It's over. The hangover from 21.
The hair of the dog.
Yeah. Hair of the dog.
All right. So,
I'm going to go see a man about a dog.
so for investors today, what kind of deals should they be looking at? Let's talk to our accredited investor community for a moment.
Absolutely. And I have the answer for them. It's
Sure.
the same answer I've had in every cycle
Mm.
for 31 years. Invest where institutional capital isn't.
Mm.
Don't compete with Blackstone. I use Blackstone, by the way. John, it's not Blackstone. I use Blackstone as a noun and not a pronoun. Because
Okay.
Blackstone, just everyone thinks of Blackstone, they think of private equity. So, you can't compete with Blackstone. They'll beat you every time, right? If they want an asset, they're gonna do that. They can take a different risk profile. It's not their money, so they're getting fees when they put out that money, and so they have a longer term view than we have, right? They can come and rescue a project with additional capital that we can't do as easily. So don't compete with them. In 2010, 11, when I started buying Class B work, value add multifamily, I couldn't get. I hadn't ever done a syndication. I had always used Wall Street money, so I went back to Wall Street in 2010 and 11,
They
and
weren't there.
and they
They?
were closed. They were
They weren't
closed.
there. Exactly.
They weren't there, so they forced me to become a syndicator.
Huh.
And I argued then. I told this to everybody. Well, Norm, who's going to buy this asset? If I'm buying a 1980s value add, great, you're going to raise the rent. So who's going to buy it 3 years or 5 years from now? And I said, private equity. Everybody's going to buy it. It's just not today. The herd will figure it out. They'll see our success. They're all going to start seeing that Class A, their returns are getting a little shallow, and they're going to jump to our space. And that's exactly what happened. The herd then followed. And of course, cap rates then came from 9 to 8 to 7 to 6 down to 3, as I said earlier, as all that capital came in. So
okay, so
don't compete with that cap.
Okay, so you've told us what not to do. Right. What should we be looking at, or what should investors be looking at? Not what not to look. What are they focused on, and what is 26 going to deliver to us? Do you think? I mean, is now the time to be sitting on cash? Should we be looking at distress? Should we be sitting patiently? You've already said you're buying, but not very aggressively. What's your prognosis for?
Pretty aggressively. We're just the market's
bit aggressive, right? Okay.
Because banks are holding back, or their deals are just not trading right now. But they're going to. They're going to. We have a very active pipeline. How many will trade this time? I don't know. But if you can buy a value add property, a deal in distress, a deal with delinquency, all those things are going to get fixed. If you got the right sponsor, all those things are going to get fixed. So we can fix the operational distress, create value. We can deal with the deferred maintenance. We can start at the right time a value add program with the appropriate ROI. We're not going to go and do it like that developer in California and LA I talked about. And, let's go do all 200 units and do it in one pallet. Let's do it at one time and we'll get lots of fees on the construction. No, go gingerly in, test the market, see what the market's saying. If it's right, let's start doing it. All that's going to happen because, again, there's no new supply coming nationally, none, relatively, in fact, CoStar, I pinned them down. 2026 deliveries will be as low as 2012. And 2012 was the lowest year in deliveries in like a 30, 40 year span. Right. Because those would have been starts that happened in 2009.
During the GFC.
Nobody started, could capitalize a deal in 2009 or 10. So that's how low. And of course, we have 40 million more people. So we're going to have a supply-demand imbalance that lasts, 2, 3, 4, maybe 5 years, just like some of the pundits are claiming. And so rents are just going to naturally go up. And how high, I don't know right now. And the reason I don't know is because in 2012, you can see what people made and what they're paying in rent. Now you're seeing what they pay, what they make and paying in rent, and it's pretty imbalanced. And I don't know how much the consumer can pay. It's not a supply demand issue, it's how much they can pay. So I think it's going to go up. I'm sure it's going to go up. And if we can solve these problems, those older properties with deferred maintenance, with lower rents, are going to be the place that will be more comfortable for the majority of the market to be able to afford. And I think that's a safer bet to make, even though there are a lot of operational risks right now that you have to have trust in your sponsor to fix.
Norman Radow. I'm pronouncing your name correctly.
Correct.
Right.
Yes.
All right, I heard you say. All right, Norman Radow, RADCO Companies. I would love to spend a lot more time with you, but we're at the top of the hour, and I don't want to keep you too much longer.
I don't want to bore your audience either.
No, absolutely not. We should do a redux because I've got like 3 pages of questions here that, in addition to the ones that I've been tapping out while we've been talking. Thank you so much for joining me on the podcast today.
It's a pleasure. I'm an avid fan of yours, and I'm glad to be in your podcast.
All right, that was Norman Radow of the RADCO Companies. What a fascinating gentleman. Thank you so much, Norm, for joining me today. What an interesting discussion. I had no idea it was going to go in the direction that it did. No expectation of that at all. So it was enormously pleasant surprise that you have the background that you do, and that we were able to talk about it, distressed real estate and how to survive downturns. Wow, how interesting a topic is that. And thank you to dear viewers and listeners for joining us today. I hope you got as much out of the conversation as I did. But that is actually, I must finish up by saying, if you've not connected with me on LinkedIn, please do so. Just go to LinkedIn and look up Gower. You'll find me that way. Connect and comment on some of my posts, and I'll reply, and we can have a chat over there in the public forum, what I call it's not social media, it's business casual media. It's a great place to get to know people. All right, over there on LinkedIn. All right, that's all I've got for today's episode. Thanks again for joining me, and until next time, this is Adam Gower signing off.